For the 14-2 work together problem, we're going to be on page 309 in the journal, and that corresponds to page 348 in the textbook. For this problem, we are going to calculate what the employer owes in taxes. The employer is going to owe similar taxes as employees. An employer is going to owe the Social Security tax and the Medicare tax, and they're actually going to pretty much match the total Social Security tax that the employees pay and the total Medicare tax that the employees pay. That's why you'll see that when we record it in the general journal, those tax payables are going to be credited again. And you're probably thinking, well, we credited them in the work together problem for 14-1, but it's okay that they're credited again because the employee matches it. So they also have to pay the same amount of taxes as the employer matches it. They have to pay the same amount of taxes as all their employees put together in those two categories. They also have to pay unemployment taxes, both federal and state. Those are calculated by taking a percentage of the salary owed. So those percentages are going to be 0.8% for the federal unemployment tax and 5.4% for the state unemployment tax. So what we're going to first do is we're going to calculate some taxes. It says that we've got these two employees, Tamala Beltran and Irma Citrin, and we need to calculate their amount of earnings subject to unemployment taxes, and unemployment taxes are owed on the first $7,000 of earnings for each employee. So what that means is the reason they give us the accumulated earnings column is because if this employee has earned $7,000 or more so far this year, they don't get none of their earnings are subject to unemployment tax. So they're only taxed up to the first $7,000 that they earn. So since this person has not earned $7,000 yet, and this is the earnings for the next pay period, if you add those together, they still haven't earned $7,000 yet. Still haven't earned $7,000 yet, then this full amount for the pay period is subject to unemployment tax. So this $637.50 is subject to unemployment tax. This next employee, they already made so far this year before this pay period more than $7,000. Therefore, they are not subject to any more unemployment taxes, so 0 unemployment taxes can be taken out for them, because they've already earned more than $7,000. $7,000 is kind of that magic number for the year. Once you calculate what amount is taxable, this unemployment taxable earnings, then we're going to total these two columns. So the total for the pay period for these two employees is $1,557.50. And the total unemployment taxable earnings are $637.50 plus 0, so $637.50. Similar to when we completed payroll records, when we calculated Social Security tax and Medicare tax, it's calculated based on the earnings for the pay period before deductions, which is this number here. So these two are calculated based on that. Remember that the Social Security tax payable percent is 6.5%, and the rate for Medicare tax is 1.5%. So we can calculate those first, remember, based on the total earnings for this pay period. So we're going to find 6.5% of $1,557.50. Remember, 6.5% is 0.065. So the employer is going to owe $101.24 for this pay period, based on calculating 6.5% of the total earnings of their employees. The Medicare tax payable for this pay period for these two employees is going to be found by doing 1.5% of this number. $23.36. The unemployment taxes are based on the unemployment taxable earnings. That's why we calculated that. In the textbook in this chapter, they said that the federal unemployment rate is 0.8% and the state unemployment rate is 5.4%. This is found on page 346 in the textbook. So we need to calculate 0.8% of the employment taxable earnings. So on 637.50, we need 0.8%, so that's 0.008. That's $5.10. For the state, we have to calculate 5.4% of this unemployment taxable earnings. $0.054. $34.43. And then we calculate the total payroll taxes that an employee is paying. We get $164.13. After you calculate the total amount of taxes that an employee needs to pay, you need to journalize it in the general journal that's at the bottom of the page. The reason it cannot go in a cash payments journal is because you're not paying cash. Last chapter or section of this chapter we were talking about paying salary, and that affected our cash account, but these are the taxes that an employee must pay at the end of when taxes are due, so they're payroll tax expenses. So if you can envision our T-charts, our payroll tax expense is increased by this total amount. So in the textbook it says to use May 15th as the date. And it says to use page 12, no, page 10 of the journal. So payroll tax expense goes first. Because it's debited, expenses are debited on increase on the debited side. And it is memorandum 46. The amount that payroll taxes expense goes up is this total payroll taxes, so $164.13. And then all of the 4 types of payroll taxes need to be listed separately. They're all going to be credited because their tax payable is going to increase. So Social Security tax payable, remember in a general journal we need to indent the credited accounts. Medicare tax payable, for the unemployment ones, write really small because we have to fit a lot. Unemployment, tax payable federal, unemployment employment tax payable state. And those amounts are credited. $101.24, $23.36, $5.10, $34.43. And this is how you journalize the taxes that an employer owes. The employer owes all of these taxes when taxes are due.